Hey, how are you? I'm Duncan McPherson and welcome back to my channel. Today is the second in this series of videos. How you as an American with Canadian income might get overtaxed because of certain differences between our two countries. And this comes up a lot as people are moving back and forth between Canada and the United States. So listen up. But before we get started, as usual, for more tips on how you can better navigate the Canadian tax system as a U.S. business or individual, don't forget to hit that subscribe button and notification bell. Or skip the hassle and contact me directly at the MacTax.com and I'll fix it all up for you so you can avoid all the BS along the way. Okay, let's get cracking. Our first topic today is principal residence. Now, unlike the United States, the sale of your principal residence here in Canada is 100% tax-free. Whereas for you in the United States, any gain you have above $250,000 is subject to capital gain tax. So if your gain in Canada is above $250,000, which is very common, you may be paying tax in the United States on the sale of your Canadian principal residence. Yuck. If this applies to you, I have a few honest tricks up my sleeve for you to avoid tax in the United States. But I caution you, most of my planning methods must be implemented in the year before you sell your principal residence. So if this applies to you, call me before it's too late to act. Just go to the MacTax.com where you can find my direct phone number and we can get this sorted out for you starting ASAP. Another way our two countries differ on the principal residence issue is, in the USA, you must have ordinarily inhabited the home for 2 of the past 5 years in order for it to qualify as a principal resident. However, in order to qualify up here as a principal residence, you must live in the house for every year that you claim the principal residence exemption for. This difference can lead you to get double taxed or double screwed. But not to worry, because I can help you here. Just give me a call by going you know where. Okay, listen up because this next one is really important. We have some pretty crazy rules up here when you change your principal residence to a rental property and vice versa. You will encounter some adverse double tax consequences up here, which can really cause you a double tax quagmire if you are not careful. But not to worry, because I can plan around these problems too. And on another quickie note, there has been a new CRA policy adopted where if you sell your principal residence before you have lived in it for 1 year, you must prove to CRA that the property was not a flip because that'll make it taxable in Canada. So just be mindful if whether or not this applies to you. And if it does, give me a call right away. But that's enough for now on principal residences. Onward and upward, my friend. Our next topic is passive activity losses. This is going to be a little awkward explaining it to you because we handle it differently up here than you do in the US, but we do get similar results. To begin, here in Canada, we do not lump different forms of passive activity losses together, which you do in the United States. So I shall go through what we do up here. First, limited partnership losses. Limited partnership losses differ in 3 major ways that you need to know about. The amount of loss deductible in a year in Canada where at-risk is available, that limited partnership losses can only be deductible against limited partnership income, and ergo, number 3, limited partnership losses are accumulated on their own and can only be deducted in future years against limited partnership income. No other forms of passive income. These differences will cause you a messy mismatch of foreign tax credits and ergo the dreaded double tax. So make sure you call me and I'll show you how to mitigate it because that's what I'm here for. Next, what I want to discuss is rental losses. But before I begin my discussion on rental losses, it's worth mentioning that I have recorded 4 videos for you on how Canada antagonizes, interrogates, and tortures non-residents that own Canadian rental properties. So go back and have a look at the first one right here if this applies to you. So rental losses are fully deductible on your Canadian tax return with only one restriction on you. That is, in the year of a loss, you cannot increase a loss or even create a loss by taking depreciation. These 2 differences can cause you tax credit craziness. And again, you'll be exposed to elements of double tax. So just call me and we can work it out. I have a few strategies to mitigate this problem for you. Quickie note, also with respect to your rental losses, we have no active participation rules up here of any sort. This is just an FYI for now, but just know that it may or may not lead to a double taxation problem for you, depending on your circumstances. And now for investment expenses. I like this one. For your investment expenses, like advisory fees and interest expense, we only have one restriction up here in Canada, and that is your investment expenses must be reasonable in the circumstances. I fell out of my chair when I found out that investment advisory fees are no longer deductible to you in the United States. I cannot think of a more unreasonable law. My condolences, my friends. But call me and I will give you some planning options to mitigate your double tax exposure here. All right, my friend, that's it for today. Did I bore you to tears? If so, my apologies. And that's probably because you don't want to be an expert on this stuff. But let's be honest, you probably watched it this far because you may already be having a hard time when it comes to Canadian taxes as a US citizen or corporation. So if this is you, don't forget, you can always call me at themactax.com so you never have to worry about this shit again. And of course, as always, don't forget to subscribe for more tax savings tips. Until next time, stay sharp, stay compliant, and stay out of trouble. I'll see you on the next video.